Hi everyone, this is Accounting Made Easy with Akim. Today I will be discussing consolidated financial statements, and this consolidated financial statements involve the account of an entity and that of a subsidiary. So, what that means is that one entity is having control in the other entity, that is, company A having maybe more than 50% ownership in company B. As a result of that, the account of that company B will have to be consolidated into the account of company A. But let me quickly make reference to IFRS 10, International Financial Reporting Standards 10, which is a consolidated financial statement. So IFRS 10 stipulates that control of one entity by the other can only occur in three instances, and which involve the first entity having power over the other entity, which is we call the investor having power over the investee. So also the power that that investor has over the investee will make that investor be exposed in one way or the other, maybe in terms of maybe contractual obligations, or maybe in terms of guaranteeing loan, or maybe in terms of any other exposure, or the investor will have right to variable returns from its power over the investee. So what we're saying is that um, there's a lot of things that can happen, not only the 50% ownership. Sometimes you might have 50% or more than 50% ownership in an entity, and after that you might still not be able to consolidate the financial statement, maybe because that entity, I mean the investor, does not have rights to variable returns. Because before, what we used to have, the understanding that we used to have is that, oh, once you have an entity that is 51% and above, then you are supposed to consolidate the entity. Sometimes you might even hold less than that 50% and still able to consolidate that entity into the other one. So what we're saying is, I give some typical examples here. I think two of them. Um, the first one, company A owns 49% of the shares of company B. So company A is directly responsible for sourcing raw materials and for the manufacturing and marketing of company B products to third parties. So what that implies is that um, having had 49% ownership in B, number one, does not justify that that entity should be consolidated into A. But what they are now saying going further is that company A is directly responsible for sourcing raw materials. That is, the raw materials for the production and marketing of company B product is solely the responsibility of company A. That means that company A is exposed to some risks, might be working capital risks in terms of making available cash to buy those raw materials, and also to be able to ensure that that company B's product are marketed. So company A is exposed, and also be uh, will have rights to some returns. So the second example I gave here is that company A created a special purpose entity, which is company B, and owes 50% in its shares. So company B obtains a loan from the bank solely for the research and development activities of company A. And as a result, company A issues a guarantee on behalf of company B. So what that shows is that company B was only like we call them variable interest entity. Um, if you're talking about US GAAP ESC 810. But for the purpose of this consolidation financial statement, we'll be focusing on IFRS 10. Maybe in another video, I'll be able to explain to you what that US GAAP actually means in terms of um, having variable interest, and so like a special purpose entity that was not the entity was only created for that purpose, and that purpose is only to obtain to do research and development activities for company A. So in doing that, company B now obtains a loan where company A guarantees it. So in another form, company A has exposure. And if you look at before the Aaron and Anderson case, a lot of entities will, I mean, the companies will create special purpose entities for this purpose, um, and the account of that those entities will not be consolidated in the financial statement. So a lot of companies will be able to use this to hide its exposure. I mean, maybe the holding company using it to hide the exposure, not presenting in its financial statement. But after that Enron case, um, ASC 810, in terms of following what the SOX and IFRS wants to show that, okay, even if you don't have that 50% or even no interest in that entity, but you have exposure or you have a right to variable returns from that entity and you're able to control the activities of the investee, then it means that entity has to be consolidated. But for now, we'll not be going deep into that. We'll be looking at 51% ownership and above, then establishing control in the entities. So let me now take you through the steps of consolidation. So I try to make um, a simple step, some steps to consolidation here. So the first step is to establish the group structure. So what does this group structure look like? This is like a tree. They having, oh, the holding company, then having investment in a subsidiary. So what sort of investment is it? Is it I mean, in terms of the percentage of investment? So the group structure would determine it. So let's look at that case of company A, B, and C. Company A acquires 75% interest in company B, while it also holds another 80% of the shares in company C. So looking at it, see this company A, like a tree down here, it shows that that company has 75% interest, if you see it here, in company B, and while it's holding another 80% company C. So the first thing for you to do when you are doing consolidated financial statement is to look at that structure, because it's really important if you're able to do this, because we'll still get to some level of explanation that this decision tree will make much more sense for you to understand the structure. So, and as a result of this decision tree, you'll be able, or this tree that I drew, be able to establish that we have some components that are not being owned 100%. I mean, outside this 75% to 100% is what we call non-controlling interest. It means in company B, company A has 75% interest, while the non-controlling interest that the entity does not control is 25%. The same thing goes for company A to C, which shows that a non-controlling interest of 20% will be established. So that is the step one. So let's go to step two. So step two, we need to determine the fair value of net asset that was acquired in the subsidiary as at the date of acquisition, and also as at the date of reporting, because date of acquisition might be different from date of reporting. So you need to establish that to determine that fair value of the asset that was acquired. In some instances, uh, we'll have the fair value by way of maybe we have valued our asset, maybe there's excess on the value of the asset, and that will impact on the equity side of the balance sheet of the subsidiaries, or the fact that that figure might not be given, we still need to find a way to to determine that fair value, or maybe by just looking at what we see in the financial statement of the subsidiary. So I'll be using an example which I already created there. So let me read it out. Using the case of A, B, and C as shown in step one above. I mean company A. Let me put company A here. Company A has acquired 75% interest in company B. Company B on 30th June 2023, when the financial statement of both entities is as shown below. So we have company A. This is company A financial statement. Um, we have company B financial statement, both on the side by side. So going further to the notes, say that company A, okay, company A paid the sum of $550,000 to acquire the shares of company B. Company B has received additional income and net profit for the period between the date of acquisition and 31st of December 2023 amounted to $32,000. So this is trying to paint a picture for us that okay, when that entity was acquired, I mean company A paid, I mean in terms of investment, paid the sum of 550,000, though it's not been stated in the financial statement here. This is a financial statement before the acquisition. So if we are to rewrite this financial statement, we need to put in investment of 550,000 somewhere here, um, below the non-current asset, or maybe we'll split the non-current asset and we'll put the investment there, and also recognize that we actually paid some cash out of this cash account equivalent, so which will reduce the value of cash account equivalent. But for the purpose of this, so let's leave it the way it is and proceed. So the requirement is that we prepare the consolidated financial statement as at 31st of December 2023. So let me go further down. Let me now start the steps. So what are we going to do? So let me take this because I already had this figure here. So let me copy and create a new um, V. So sorry, I'm using this. Let's close this. So I have the financial statement. It's the same thing I was showing to you on the file I was reading to you, and so it's the same thing. So so what we're doing here is to determine, which is the step 2. We are trying to determine what the net assets as at the date of acquisition and net assets as at the date of reporting. So date of acquisition, so let me just put this here, then I'll see transfer. What we're saying is that for the purpose of this discussion, there's no fair valuation of the asset of company B, so we'll be using share capital, share premium, and retained earnings as the net asset. So let me net assets of company B. So 30 June 2023, that is date of acquisition. Then 31 12 2023. Then we need to maintain line of difference here. Sorry. Difference, if there's any difference between them. Okay. So the first thing we need to look at is the share capital. Push this a bit. So the share capital of company B is $120,000. Is it the same as at 31st of December 2023? There's no information to that effect. Then we'll assume that that figure remains the same. The difference is what? 0. So the next one is to look at the share premium. Share premium is 300,000. We're looking at company B, so don't worry about company A for now. Is there any difference in the share premium? Nothing has changed. It remains at 300,000. Then this is 0. So the next thing to look at is the retained earnings. So because that was what was acquired. So here we have 45,000 as stated in the financial statement. But there's a statement here. If you look at it, to determine the retained earnings as at the date of reporting, we need to consider that company B has received additional income, and as a result of that, the net profit for the period between the date of acquisition, I mean, there's a share of net profit. I mean that net profit that the company realized from the date of acquisition to 31st of December, so which is 32,000. So we need to add 32,000 to 45 that was already there, and that should be 70. That's 77, right? 77,000. Okay. So is there any difference? I think there's a difference, and that difference is 32,000. So is there another thing to consider? There's none. If there are things like maybe fair value adjustments, maybe um, um, share of maybe post unrealized profit, provision for unrealized profits. Maybe if there's any transaction between the holding company. For the purpose of determining this, so let us limit the discussion to what we have present here. So the net assets value will be um, 120 plus 300, that is 420, and 420 plus 45, 465. So $465,000. Then 120 plus 300, that is 420. 420 plus 77, that is 497. 497, yeah, that's correct. 497. So the difference remains 32,000. So we can highlight it. The same thing here. Both highlight it. The same thing here. Boom. Bold. Highlight it. So now we have been able to determine what the net assets of company B as at the date of acquisition and as at the date of reporting. So the next step, which is step 3, is to calculate if there's any goodwill as a result of the acquisition of subsidiary. So let's calculate the goodwill that will sit in the account to be consolidated. Goodwill on consolidation, or goodwill at the date of acquisition. So we now need to calculate. So what's a goodwill? Goodwill um goodwill will always occur when um the purchase consideration, is much more than the fair value of the asset acquired. When you pay more for the asset that you acquire, it means you have actually paid more, that the company has a positive goodwill. So that's why you have acquired the entity. So what we'll be looking at is the purchase consideration. Purchase consideration. Then also So when you look at purchase consideration, then you also need to look at um, non-controlling interest. That is the value of the fair value of the non-controlling interest at the date of acquisition. So we need to look at that. So um, we haven't determined the non-controlling interest in this calculation, but we'll do it here. So the purchase consideration as stated in the question is 550,000, which is stated here. So let me go back up. Um, the purchase, yeah, is mentioned there. Yeah, yeah. So so this is the value of purchase consideration, which is investment. Let me highlight it in yellow to see that that's the purchase consideration. So what is a non-controlling interest? Um, so the value of the non-controlling interest we need to calculate it because it was not directly given that there's a fair value, because we also need to look at the fair value just like the net asset. We also need to look at the fair value of the non-controlling, but it's not also given. So we assume that that's total net asset value of 465. I mean $465,000 times. In the question, it was stated that, look at it properly. It was stated that company A acquired 75 interest in company B, and based on the structure that we established, I mentioned that um, any interest after this 75% is the non-controlling interest, which is 25%. So the same thing is the same approach that we use that 25%, which is 25% of the 465. So what is that value? So if I make my calculation, 25% of 465, this is 465 here, times 25%. This, this, that is 116,250. 116,250. So that figure I will need to bring down 116,250. That's it. So be 550 plus 116,250. That is 666,250. So the simple paper calculation on the side here. See, that should work. Make it faster than what I'm presently working on here. Okay, yes. So 666,250, 666,250. So then what is the fair value of net assets at acquisition? So we need to revert back to our calculation of, which is this 465 that we got here, because that's what I stated earlier, that because the fair value was not given, so we assume that that book value, I mean the carrying value in the balance sheet, are the fair value of the asset acquired. So which is a 465 for 165. So so what we're doing is to less fair value, which is taking it out. So goodwill will now be difference between the total and the, so the goodwill will be 666,250 minus 465. So let me go back to 465. Now calculate our goodwill minus 465. So the goodwill shows 201,250. So let me go back. 201,250. I hope it's still making sense to you. Why we're calculating the goodwill, because the entity has paid more. Because when you're doing acquisition, it's expected that the value that you acquire the entity might not be the value of the fair value of the assets in the book. So you need to calculate if it's a positive or a negative goodwill. So according to the International Financial Reporting Standards, if you have the value of purchase consideration, non-controlling interest, which is more than the fair value of the net asset acquired, then it means you have to recognize goodwill. Another case is when the fair value is now more than the fair value than the purchase consideration and non-controlling interest. That is what we call bargain purchase, and that bargain purchase, there's another treatment, so we'll get to that. So I don't want to bug you with too much information at this stage. So that is the step. So step 4 now is to now calculate non-control, that is, we call it, let me call it NCI, at the reporting date. So because when the asset was acquired, it was acquired, I mean the entity was acquired on 30th June 2023. So but as at the end of the financial year, when we are consolidating the financial statement, we need to state non-controlling interest as a separate line item in the financial statement. So but we will not be using that same non-controlling interest that we arrived at here, this 116,250, because that value will have changed when the entity is now reported, which is 31st of December 2023. So let's go into it. So NCI at acquisition. NCI at acquisition is the 116 that we got above, 116,250. Then we now need to look at what has changed in the net asset of the company B from the date of acquisition to the date of reporting. So we go back. If you look at that, that's the essence of having this net asset at acquisition and net asset at reporting. So the difference that we got here is 32,000. So this is what we call post acquisition change in reserves. So post acquisition change in reserves, we will now say NCI percentage of post acquisition, maybe profit or loss, but I'll call it reserve for the purpose of this discussion. So NCI percentage change, which is, what is the NCI? NCI remains 25% that we discussed earlier on, then multiply by the $32,000. So what would that give us? 116,250 plus 32,000. What's the 25% of 32,000? So let me go back to my Excel. 32,000 times 25%, which is 8,000. So 8,000 will be brought in here, $8,000. So when we sum it, total NCI to consolidate. This is the NCI that we are consolidating. So 116,250 plus 8,000. 116,250 plus 8,000. That is 124,250. So 124,250. One no dollars. 124,250. So that is another one to be highlighted, which is going to our consolidated financial statement. So we have determined our goodwill here. Determine our goodwill. Bold. We have determined our non-controlling interest. So what are we now consolidating in terms of I mean the next step to look at step 5, which is not really a big deal. We may not go through that step 5, but we can do it in our consolidated financial statement when we're doing it. But let me tell you what. So what we're doing now is to look at um, retained earnings to consolidate. So we have company A retained earnings. Then also share of company B post acquisition profit. So let me explain to you why we need to do this, because um, if you look at the balance sheet here of both entities, the balance sheet of company A and the balance sheet of company B shows that there is a $45,000 value as retained earnings. But this value is not the value that we consolidate, because that entity was not acquired when that 45% retained earnings was attained. You understand? So what we now be looking at is post that period, after that period, what has happened. Because when you say, oh, you have bought an entity, you need to share from profit or loss for that entity. So from the date of acquisition, it shows that we have attained additional 32,000 net profit, which is what will go to the group. You understand? So that's why we need to calculate that. Um, but let's take it one step at a time. Company A's retained earnings. What's the company A's retained earnings? That's 132,000. This figure here, 132,000. 132,000. 132 dollars. 132,000. And what is the share of companies B's post acquisition? Just like what we did in NCI. Let me take one more step down, because so that it won't look clumsy. We said it's 25%, but here is 75%, because that's the true ownership times $32,000. $32,000. $32,000. So the percentage share of it is so let me go to, like I used to do, my Excel makes it faster. So I'll take 75% times 75% is give me $24,000. So $24,000 is what we need to consolidate with. So total retained earnings to be consolidated. Okay, so the total will now be 132. That is 156. $156,000. That is the retained earnings to consolidate. So what we now do is now go back and put the balance sheet side by side and try to see how we can consolidate them. So let me cut. So we'll be using this Excel file. It makes it easier for me and it makes it faster. So we now combine. We have company A, company B. So combined. Let me say combined. So look at assets. Combine the assets. Current assets. We should combine everything, but we'll eliminate it. Don't worry. We'll come back and eliminate all of them. We'll eliminate all of them. Then we need to include some lines because of the goodwill that we have, and also after the retained earnings here, we need to create what we call non-controlling interest. Non-controlling interests. Okay, so the way I used to do it, I will have journals. I call it journals. Um, debits, credits. So what do we debit? What do we credit? Then we have consolidated. Consolidated FS. FS. So this will be in the middle. Okay, so here we need to eliminate the first thing we need to do. No, the first thing we need to do, don't forget that um, we said that the investment was not shown. So I think we also need to have investment column here. We have investment and we have goodwill here. So when we bought, I mean when company A bought company B, he paid $550,000 as the investment. So we need to credit our cash and cash equivalent with 550. Okay, let me, sorry, plus this, that we can display the elimination in debit and credit. Um, so we now need to look at it. So when we paid 550,000, so that 550,000 will have gone out of the books of um, company A. So I'll put journals here. I'll put it below. Let me add column. Now let us pass the journal entry for. Let me take this out then so that I can start explaining what I'm doing. So we need to pass the journal entries to post these transactions that we did. So what I try to do is that on each of the steps of um, the calculation of goodwill, NCI, and retained earnings. So I try to put the debit and credit journals that we need to pass. While we're debiting goodwill here, is that you know initially we'll have posted investment of 550,000. So we need to write off that investment to goodwill account. That's why we debited goodwill here and credited investments. Um, The value of the NCI that we got here, we need to credit NCI to realize the NCI because initially we don't have NCI in the book. So now we bring in NCI, so we need to credit NCI as a liability in the books. Then that NCI value should be written down to goodwill account because the essence of having this is to calculate the goodwill. The other one is to also write off what is in the net asset of the entity in terms of the share capital, share premium, and retained earnings. Write them off from the share capital, the equity. Let me put equity here so that equity has is a component of share capital, share premium, and retained earnings. Then we now write it off to goodwill. So let's pose the journal one by one here. I've done a pro forma statement of financial statement here. So let me start putting in one by one entries. The first one is because the first one is we debit investment because we did not realize that investment in B. We did not realize that before. Now we didn't put it there, so we need to put it down because the notes in the calculation shows that company A paid the sum of $550,000 dollars for shares in company B. So debits investment, then we'll need to credit cash and cash equivalents. $550,000. So that's the first step. So let's post that immediately. Yeah, debits investment and credit cash and cash equivalents. So that's first entry. The second entry is to now start writing off everything to goodwill. So we need to debit goodwill with what? We showed it up here. This 550,000. Then credit investments. To, the same 550,000. Okay, there. The next one is to debit equity side of the financial statement, which includes share capital, debit share premium, debit retained earnings. So what we're trying to do is to arrive at this figure of 465 here that we have here, this 465. But that 465 is a combination of three line items. So I can quickly go to where we calculated our net assets at acquisition to bring it down. So the next thing doing is NCI. We need to recognize NCI. So we are crediting NCI, credits NCI with what? That value that we have up here. So all these entries will be written off to what? Goodwill. Don't know whether it's debit or credit. Let's leave it that way. Let's do auto sum from here down 66. So take the same value. So goodwill will be the balancing adjustment that we have to be this one minus sum of from here something is missing. I think something is missing there. I think one line item is missing to discover what is missing. Investments. Okay, okay, okay. Yeah, 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 yeah. Sorry. Um, this is one line. Goodwill has been debited here, so we don't need to debit goodwill yet. We only need to show because goodwill should be the balancing adjustment. So whether it's debit or credit, but I think to be debit. So let me close this one. Yeah, yeah. I think I found the error. So the debit on the goodwill I put here is an indication that we have this value minus sum of these values. So goodwill is 201. So what we are debiting to goodwill at the end of the day is the 201 to 50. So let me now pass those entries. Here goodwill 201 to 50. Next one is investment credit. Uh, Credit investment. Yeah, the next one is we debit share capital and others. I mean the equity side. The three of them. The next one is credit NCI. NCI on 16 to 50. So everything is correct. I mean journal 3 will now be 3. Um, yeah, journal 3 will include addition to NCI and also addition to retained earnings. So for the purpose of this, though in the question it wasn't stated how we arrive at the 32,000 um, um, profit in the group, but let's assume that there's a liability that we incur to that there's a liability that we made provision for to incur the expenses and also earn the income to get our net profit of 32,000. So let's pass it directly to liability. So what I'm doing here is um the liability, let me say debit um liabilities for 32,000. Yeah, 32,000. And what am I crediting? I'm crediting NCI, and also I'm crediting group retained earnings. The reason why I'm doing this is to split that post acquisition profit in company B between the holder of the majority shares, which is company A 75%, and NCI of 25%. So I've done the calculation up here, so I don't need to waste my time. Just pick the 8,000 here, then I pick um, this one here. So the total is 32,000, as you can see. So let me pass that journal. So let me pick current liability to be debited for the 32,000. It's just an assumption. So then I will credit non-controlling interest. I already have a figure there, so let me just put this plus sign here and then add this non-controlling interest. Then retain earnings 24,000, which is group retain earnings. So as you can see, let's do some little checks. Let's see The retained earnings that we got here is 156. This is the same as what we got in our steps with step 5. Is true. The same thing with um non-controlling interest. Is it the same? Let's go to non-controlling interest. Yeah, it's true. The next step, let's look at our, yeah, because those are the items that we added to the balance sheet. Let's look at goodwill. Is it the same? Yeah, it's the same. So in a nutshell, this is how to prepare consolidated financial statement from the scratch. So we have been able to dissect all the steps from 1 to 6 to have a better understanding, but there's still more under consolidation. I think you should watch out for more of my videos YouTube. Then because where I did a separate because in consolidation you need to start considering elimination of intercompany entries. If there's any intercompany sales, there's unrealized profit between the entities, the shareholder selling an item to the subsidiary, or subsidiary selling an item to the shareholder. You understand? So all these things I discuss in a separate video, so you can watch it separately on my YouTube channel. Thank you so much. Thank you.